Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Intel's earnings for Q3 2019. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company is doing. So let's get started. The first thing I want to say, all the information I have collected came from Intel's investors website. I've also used Seeking Alpha to take a look at the transcript of the earnings call and some other news article from Seeking Alpha. Right off the bat, we're going to look at the stock price review. So performance from the 5-day, it has been about 9% gain just today alone. It went up 8% after earnings. 1 month performance has been 11%, year to date has been 20%, and over the past 1 year has been 23.5%. So the company is doing pretty big, but if we take a look at the chart, there was a moment where it took a huge dump, and ever since it's been trying to kick it back up, and it has yet to hit the highest, its high of about $59. So maybe that might be coming soon. So now, right off the bat, the first thing we're going to talk about is revenue. So for revenue Q3, they gave a non-GAAP earnings per share of $1.42, which beat by 18 cents. GAAP earnings per share of $1.35 also beat by 19 cents, and revenue of $19.2 billion beats by $1.13 billion, and it has about 0.2 year-to-year growth. So for the first thing, the first point is going to go to Bull Solo here. And that's pretty impressive, right? We definitely know that the tech sector has taken a slowdown, especially with all these tariffs talk happening and all the tariffs going on. And it's pretty impressive that they're still at least flatline in revenue compared to the same time last year. And we can see, right, that an analysts were thinking that this would have a lot less revenue, but it did beat by $1.13 billion. That's about 5% beat. That's definitely a huge number. So obviously, first point is going to go to Bull Solo, like I've mentioned. All right, so next we're going to take a look at comparable sales, and here we're pretty much going to look at sales this quarter compared to the same time last year. So September of 2019 compared to September 2018. Like we mentioned, right, revenue was $19.2 billion. I want to break it down for you guys just so you guys can see what the total revenue is broken down of. Remember, revenue is up only 0.2% year to year. The main portion of this revenue is Client Computing Group. So Client Computing Group is about 50% of the revenue, and unfortunately is down 5% year to year. So we can see same time last year was $10.2 billion, where right now it's at $9.7 billion, about $500 million less. Data center, and we can see this is where the major slowdown happens, even though it was only a 5% decrease, because it is a huge 50% of the total revenue. It takes a big chunk of it. So if this was flatline, then this company would be doing a lot better. Data center group, which is probably one of the most important things with such a market right now, and with AMD right now trying to take over the data center group, it's good to see that that data center is still growing. So data center group has 33% of revenue, and that's definitely a huge amount as well. And it's up 4% year to year. The consensus was for it to be $5.62 billion, and it actually made it to $6.38 billion. So it did beat estimate analysis by a huge number. Internet of Things, which is made up of two things, IoTG and then Mobile Eye, are both up. They make up 7% of total revenue. IoTG made $1 billion in revenue, which was a 9% gain. Mobile Eye was $229 million, which gained by 20%. So we can see we can see Memory Solution Groups, which is the next thing. It's also 7% and it's up 19%. And then we have PSG, which is Programmable Solution Group, which is about 3% of total revenue, is up 2%. So it's good to see that everything else that's smaller percentage of the revenue is increasing. And that's a good thing, right? Because we see that Client Computing Group is a huge portion of it. And when one item is a huge portion of revenue, if that item goes down, it's definitely bad news. But it's good to see that everything else is increasing. So eventually, all these other stuff will also hold more weight. And this company does not have to worry with one specific product for it to actually keep going. Like I said, total revenue is $19.2 billion. Compared to the same thing, it's only 0.2% better year to year. But for right now, I'm going to have to give comparable sales. We're going to see, I'm going to give a point to actually both Bull Solo, well, this is Darth Bear, so I'm gonna give a point to Darth Bear and Bull Solo. And the main reason, wait, nope, this is Darth Bear and this is Bull Solo. And the main reason is we do see an increase in comparable sales for the smaller items, and that's a good thing. So that's why we're giving the point to Bull Solo. But the overall total net revenue is pretty flatlined, and that's not something one likes to see. So that's why Darth Bear also gets a point in this one. We're going to keep talking about comparable sales here. And right now, this is mainly in the client computing group and the data center. So I'm only going to be talking about these two because these two things make up 83% of the total revenue. So this is going to be year-to-date comparison. So this is going to be January 2019 till September 2019 and January 2018 to September 2018. So right, we're going to see 9 months year-to-date, and we can see client computing group is the first thing we're going to talk about. And client computing group is broken down into major two things: notebook sales and desktop sales. Notebook volume sales down 6%, but prices are up 6% when compared to 2018. Desktop volume sales is down 10%, but prices are up 5%. So we can see a trend going on here. We can see right that total volume sales is definitely decreasing, and that's a bad thing. So that's why I remember I gave a point to both Darth Bear and Bull Solo. So that's another reason Darth Bear would get the point, right? Overall, volume sales are down, but prices increasing are going up, which means, right, people are willing to pay more for these stuff. Next, we have the data center group. So data center group unit volume is down 8%. So they are selling less data centers, but the average sale price, it's up 4%. So we can see there has been an overall slowdown, and it does seem like the market knew there was going to be a slowdown, right? That's why an analyst determined that there was going to be slower revenue, but Intel proved them wrong and beat their expectations. All right, and then this final slide, I'm not going to talk about it. You guys can pause it if you guys want. This is what each of those revenue breakdowns really include, right? So here it tells you what the memory group is, what the programmable solution group is. So if you guys want, you can pause this slide and read all this, and just so you guys can see what the revenue breakdown is about. All right, so on this slide, I'm just gonna say this is things to note, and I'm not gonna give a point to either Bull Solo or Darth Bear on this one, just because these are things that I can't really scale. There's so many things, and so many things to talk about, but it's just something I want to share with you guys. And the first thing is, I did listen to this company's earnings call, and I did read their transcript. And one thing I do admire is the teams, this company's leadership, especially the CEO when he was talking, the way the confidence that he projects to the room is pretty amazing. And I do think leadership is one of the most important things when having a strong company. So it does make me feel comfortable that this company has a good leadership. The first thing they talk about is that they expect to generate about $85 billion in revenue and about $6 in earnings per share in the next 3 to 4 years. So that means with a forward PE ratio at the moment, that is less than a 10 PE ratio, and that's actually pretty good. I mean, they do talk about how they're going to get there. Obviously, they mentioned that they're just by saying it doesn't mean it's going to happen. They have to make them smart decisions. They have to generate the right amount of investments and put the money in the right amount of future innovations. And that's, again, pretty good to see that this company has ideas of where to go. They also talk a lot about the type of customers they have for their data center groups. They mention a lot of big names like AWS, Google, Alibaba, and how they mentioned that they ramped up their second generation based on these customers. They also include some customers on their higher performance Xeon, which is their highest data center group. They mentioned BP and TU for there. They also mentioned that one of the key reasons customers are choosing the Xeon and is because the platform is built in workload for acceleration for AI. So it's built in for future proof of AI beliefs. They also continue to talk about their breakthrough through memory technology. They have a new collaboration with Oracle, and Oracle is incorporating the high performance capabilities on their Intel Optane, which is their new solid state memory device, I believe. I know I see a lot of laptops showing it right now, which powers high performance database infrastructure at most of the world's leading banks, telecoms, and retailers. So this is, again, pretty good news. Then they go into client computing. They are excited that all of their major PC OEM customers have Ice Lake designs, with 18 already shipping out of 30 expected to launch this year. So this company is definitely doing great things and moving into the good things and moving forward. And that's always something good to see in a company. And I just wanted to share that with you guys. Another thing they do, so these are some more things to know, and I enjoy this. They expect second half PC client supply will be up double digits compared to the first half, and expect to further increase their PC client supply by mid to high single digits in 2020. So we did see earlier in the comparable sales that PC desktop supply and notebook volume sales have both gone down. And they're saying that yes, they did see the slowdown as well, but they do expect the second half to have higher double digits compared to the first half. And that's actually pretty good news. So next, they want to say that their growth on their products hasn't been sufficient, and this is inventory wise. They're letting their customers down because PC demand has exceeded their expectations and surpassed third-party forecasts. So they're trying to ramp up on production because they are seeing higher demands than anticipated. They are also on track for their first 7 nanometer based product, a data center focused discrete GPU, in 2021, 2 years after the launch of the 10 nanometer. They're also well down the engineering path on the 5 nanometer, and this is the first time they've actually talked about the 5 nanometer. They didn't say much. Obviously, they're just in the engineering path, so they're just discussing things. But it's pretty impressive that they're already thinking about going further than 7 nanometers. And this is one thing that AMD folks have been pretty happy, you can say, like, talking about, is that AMD was probably the first to come out with the 7 nanometer, and they also have their discrete GPU on, well, it's not discrete GPU, they have their own GPU for their data center devices. So now, right, Intel is trying to catch up to them, but performance-wise show different. Just because AMD hit 7 nanometers doesn't mean that theirs is performing better. There's mixed reviews at this at the moment, and you guys can check them out if you guys really want to take a look at performance-wise. All right, so next we're going to talk about the company's future plans and where their priorities lie. This comes from their investors' earnings slideshows, and you can find this in the investors' website. But they have 3 plans. They have accelerating growth, improving execution, and deploying capital. So the most important one I like is deploying capital, and I want to talk to you guys about the points here. The first thing is they want to increase research and development and CapEx over time. So this is pretty right. One way to become better is to increase your research and development. Never stop researching, never stop innovating. So I'm happy that they're increasing their capital on there. They also return, which I think is pretty crazy, 122% of free cash flow year to date to shareholders, and they're committing to 100% return of free cash flow in 2020. That is pretty ridiculous, if I may say so. I honestly would prefer this company use more for research and development, but hey, who am I to say anything? They've also increased buyback by $20 billion, repurchasing $20 billion in shares in the next 15 to 18 months. That's a lot of shares that they're going to buy back. All right, so next let's move back to the first one, accelerating their growth. Again, they mentioned that they have so many big companies, AWS, Google, Alibaba, and they have strategic collaborations with Oracle and Optane. So they're showing us that they have strong customers and they're working on deals to continue their growth. Then they want to improve also their execution, and the main reason is to increase supply output and respond to the stronger than expected demand. So again, all these are very, very good things to hear about the company. And for that reason, we are going to give a point to Bull Solo on this one. So I think Bull Solo is actually a point ahead or 2 points ahead at the moment compared to Darth Bear. But Darth Bear can catch up. This company is not perfect, but it's definitely looking like a strong, healthy company. Next, we're going to take a look at shareholder return. And if you guys are of Intel, you guys know that this company does have a strong shareholder return. We actually looked at it before. This company is devoted to give back a huge amount of the free cash flow to shareholders. Like I mentioned, they have a $20 billion increased buyback program in the next 15 to 18 months. They do pay dividends about 2.41%. So obviously we are going to have to give a 0.2 bull solo for this shareholder return. Next, we're going to talk about debt, and this one is not one of my favorite things to look at. Well, this is my favorite thing to look at, but what I see here is not something I enjoy. So the first thing is we're going to take a look at current liabilities. This is December 2018 and compared to now, so it's 9 months later. So 9 months later, this company has increased its short-term debt. Short-term debt in December 2018 was $1.2 billion. Right now, it's sitting at $5.2 billion. Accounts payable has also increased, and compensation and benefits have decreased. So that means one thing: this company might have had some layoffs in the past few months compared to December. So total current liabilities last on December 9 months ago was $16.6 billion. Right now it's sitting at $25 billion. So there was a huge increase in total current liabilities, and that's something I do not like to see. The next thing is total debt. December of 2018, 9 months ago, this company had $25 billion in debt. Now this company has $23.7 billion. So even though most likely some of that debt has transferred over to short-term debt, it's nowhere near where this company, right? It's 1.7 difference in total debt, but there's been about a $4 billion increase in short-term debt, and that math doesn't add up. So that's definitely I'm not a fan of seeing that. So obviously here we're gonna have to give a point to Darth Bear. Now we're gonna take a look at outlook based on analysts. The first thing we're gonna take a look at is earnings per share. So earnings per share is not increasing. So this should say decreasing. Earnings per share is decreasing. For 2019, this company is expected to make $4.38 of earnings per share, and in 2020 this company is expected to make $4.22 of earnings per share. So there is a slowdown there. The next we're going to see is revenue. Revenue is in fact increasing though, but it's not increasing by a huge amount. Revenue for 2019 is expected to be $69.77 billion, and the next year is supposed to be $70.91. So about $1 billion increase, which is less than one. That's about a 2%, not even a 2% increase. And we can see this is a big company, right? $70 billion is a huge amount. And we can see there is not much. This company is growing at a slow rate. One thing I don't like is seeing that earnings per share, though, year to year decrease. That means one thing, that even though revenue is increasing, earnings per share is decreasing. That means their gross margins, their profit margins are gonna go down, and that's definitely not a good thing I want to see. So it is a slow company. This definitely is a slow growing company, and it's a strong company. But because it's a slow growing, we're seeing that negative earnings per share delta. It's not going to be a negative earnings per share, but the delta between this year and next year is going to be a decreasing one. I'm going to have to give another point to Darth Bear. So I think Darth Bear has actually caught up. The final thing we're going to take a look at, but hey, one thing to see is no matter what we're looking at, the forward PE ratio for this company is about 12.38. I'm expecting at the with the current price. Actually, with the current price of 56, 422, that's probably about a 13 PE ratio not right now, compared to the 12.38 that it is. But it's less than the 15 PE ratio, and for a technology company, that's actually, in my opinion, pretty low. I know this company can go up and down pretty rapidly, especially with all the competitive going on. But for a technology company, a strong technology company, a company that pays back its shareholders pretty strong, a company that's doing plenty of buybacks, a company that's growing, a 13 PE ratio is definitely pretty low in my opinion. It's definitely not a company that would hurt to have in your portfolio. Now next we're going to take a look at the outlook based on the overall company. Let's first take a look at full year 2019 outlook. So here they're saying that this outlook is going to go up to $71 billion. We're expected, where the professionals are expected to have, say, 69.77 Intel says, nah, fam, we're actually going to make $71 billion. And that's up $1.5 billion compared to last quarter's guide. So that's good news. They are expected higher revenue because of slightly up year to year on data-centric and PC-centric values. Operating margins, unfortunately, is going down to 32.5%. It's down. It's going to be down about two points year to year. And they do mention some of the reasons here. Earnings per share is expected to go up 20 cents compared to what they expected in July. So $4.60. Let me actually just do the math really quick. 1 second. Let me just do a calculator. Where's my calculator? So right now I think it ended at $56 divided by $4.60. That gives this company a current PE ratio of about 12 PE ratio. That's actually pretty good based on what this company is expected to see. And that's higher than the company's estimate. But I wonder if this is GAAP outlook presented on a non-GAAP basis. And I wonder if this is a non-GAAP basis either. So now let's take a look at quarter four outlook. Quarter four outlook, they do say revenue is expected to go up. Like they did mention, operating margins is expected to go down, and earnings per share is expected to go down compared to the same time last year. But because we see that huge revenue outlook on the full year, and we see that uptrend on earnings per share, I'm gonna have to give a point to Bull Solo. So that's it. That's it for now. I hope you guys enjoyed this Intel episode. This is definitely a strong company. I'm not gonna lie, I'm usually an AMD guy, but I can't deny the fact that this is actually a strong company. This is a very healthy company, and it is a company that I wouldn't say it's a bad thing to have on my portfolio. And I think anything below a 15 PE ratio on a tech company is pretty cheap. But at the moment, I have yet to take a look at their 10Q report because they have yet to post it. But once they post the 10Q report, it will help me look at how this company is looking numerically wise to help me really determine what I would gladly pay for this company. But I think even with the 13 PE ratio, I wouldn't mind buying a small portion of investments in it. Like I said, it's definitely not a bad company to have in your portfolio. It's a company with strong revenue. It is a big company, a company that pays back strong shareholders, a company that has a strong plan for the future. And we see that this company has plenty of breakdown revenues that can help this company if one of the sectors goes down. So like I said, this is definitely a strong company. I hope you guys enjoyed the episodes. Let me know what you guys think. Post in the comments. Give me a thumbs up. Subscribe to my channel. Share with you guys. And if you guys don't want to watch the videos anymore, find my podcast. You can just put Jose Najarro Stocks and you will see my podcast. And this episode will be in the podcast. So take care, guys. See you next time and have a good night.